If you own multifamily properties here in Southern California and you're curious, where are property values? Where are rental rates headed? What's shaping the dynamic of the multifamily market here locally? I have all the facts, figures, data. We're going to do a deep dive. Stay tuned. Hi, this is Kris and welcome back to the Apartment Dealer Show. Today is our market update. What took place over the course of 2024 and what's the data as we head into 2025? This is probably one of the most anticipated videos that we record all year long. My team and I have dug through all the data, all the sales in the corridors, the service area, the geographic area that we cover. And I'm here to update you what exactly happened with property values, where are rental rates, all the data in between, and more importantly, what's shaping the dynamic of the multifamily market. So let's dig in. First, let's take a look at 2024. What happened over the last 12 months? And where did that leave us as we began 2025? Let's start off with increased tenant protections. Now, over the course of 2024, obviously, tenant protections only increased, right? Things only got that much more difficult for landlords. There's a couple of things here that I want to focus on because, again, this is the main talking points of what's shaping the market. Number one, when it comes to substantial improvement. The laws changed last year, April of last year, 2024, when it comes to no-fault evictions, specifically around this particular tenet of the law. When we're looking at substantial improvement. So prior to April 1st, you could simply give a tenant a 60-day notice to vacate if you were going to do substantial improvements. And I don't want to walk through all of that here. We have plenty of videos on our channel. But as of April 1st, 2024, that changed. You still can vacate units to do substantial improvements, but now you have to engage a contractor. You have to pull permits. You have to give a copy of the permits to the tenants, on and on. In other words, it's become that much more difficult. And so for even the most aggressive investors who, even under rent control, were still able to buy properties, reposition properties, and then sell them or refinance them with, take out some equity and so forth. Now they've become gun shy to say, you know what, this is obviously going to become more costly. Engaging a contractor, dealing with the cities, having to give that much more literature to the tenants in terms of what's being involved. It's just too complicated. And now they see that as maybe that's not an avenue that they can pursue. For those maybe that weren't doing that type of work, there's other things to be concerned about, such as the security deposits. Now you can only collect 1 month's worth of rent as a security deposit. So your risk, right? You're not able to mitigate that risk. Maybe there's a tenant, and whether given their credit, income, job history, or something, you gladly would rent to them, but you would ask 2-3 months security deposit. Well, now you're limited to 1 month security deposit. And for anyone who's taking back a unit, you have to renovate a unit, improve a unit, you know that 1 month's rent does nothing in terms of paying for, let's say, even if the unit just has to be painted, in many instances, that's only going to cover a portion of your expense. So again, tenant protections, those increased, that's shaping the dynamic of the market. Now let's talk about increased cost. And first, probably the first thing that comes to mind is the increase in the cost of property insurance. State Farm, for example, issued in 2024 about 40,000 letters of non-renewal. And I don't want to just beat up on State Farm. I am the recipient of one of those great letters. Many of you probably watching received the same type of letter from State Farm. But Mercury and others basically said, look, they either don't want to insure multifamily properties, they don't want to insure your particular property for any number of reasons. And so this has doubled, tripled the premium involved, right? Increased cost. Now, when you move over to increased maintenance expenses, not only has labor increase, material costs increase, but going back to the insurance issue for a moment, well, now you're having to update your electrical subpanels, your main panel. They don't like your roofs. They're taking these drone photos of the buildings, not even walking onto the property and saying, hey, your roof looks a little deteriorated. You have trees overhanging a particular roof, and these are the reasons why we're not going to issue a renewal this year, or we're going to increase your premium dramatically. So tenant protections, increased costs, they're casting a shadow over multifamily ownership. Now let's shift to commercial financing. Obviously, beginning near the end of 2022, interest rates began to rise. So that's not a new thing for 2024. The interesting thing is that at the end of 2024, the federal government had lowered the interest rate, the federal rate, and that only increased the rate for mortgages. And many might say, well, how does that make any sense? Isn't the interest rate for mortgages directly tied to what the Fed does with the rate? Not necessarily, especially when it comes to commercial financing, because commercial loans typically are tied to what's going on with the Treasury market. So bottom line here is we're floating above a 6% interest rate, and we have been for some time. As of the recording of this video, we're standing at 6.5%. And what does that mean? That's a dramatic hit to cash flow. And I'm going to give you an analysis here at the end of the video so you can understand why that is. It's not as simple as, well, interest rates go up, so property values go down. Not always, not necessarily. If you just watch my recent video that I recorded with Bruce Norris, we walked through some of that. But I'm going to walk you through why today it has impacted property values dramatically, that being the interest rates. Now, having said all that, in 2024, we did see an increase in overall sales volume, at least in those corridors, the geographic area that my team and I cover between Los Angeles County and San Bernardino County. We did see a 10% increase in sales. So one might ask, well, why is that? If there's increased cost and there's more tenant protections, in other words, it's only becoming that much more difficult to own and manage multifamily properties, why are sales increasing? And I think we have to look at the asset class itself. Investors see it still as stable and reliable. If you take a look at rental rates, for example, while we're not growing at the pace we were in 2021 and 2022, most places have grown stagnant. This year, projections are we're going to see single-digit increases for the most part. So the bottom line, though, is that rental rates have not dropped off, okay? Even in light of things that maybe one would have thought would cause them to decline, rental rates are up. And what about vacancy? Bottom line is the buildings are full. It might take a little bit longer to fill a vacancy, but the buildings are full. And so in this dynamic of, well, owning and managing properties is shifting and changing, right? The day-to-day management, the cost, and so forth. You've had an influx of new buyers. And I know this is across the board, whether it's Los Angeles County, Orange County, San Bernardino County, Inland Empire, we track the sales. And there's a huge influx of what we'll call, quote unquote, new buyers, new investors to the market. And what do I mean by that? Well, we're taking a look at when there's a new buyer for a property, have they owned multifamily property previously? And the best that we can tell through our research is that today, of the buildings that are selling, 60% or more of those properties are being purchased by first-time buyers. A dynamic that we haven't seen at least as long as I've been in the business. If you would ask me the same question a decade ago, Kris, who's purchasing multifamily properties in the areas that you service? I would have said it's probably about 70-75% of the existing investors already, and maybe 20 to 25% new investors coming in annually. These individuals, doctors, lawyers, people of high net worth, people that own, say, small businesses and what have you, they're looking to enter into owning multifamily real estate, and they have the capital to do so 10 years ago. Today, that dynamic has shifted. So why is that? Why is it that there's more new buyers that are entering multifamily ownership who lack the experience that, say, you do if you've owned for any length of time? And I think it's very simple. They lack the experience, and they don't have that previous knowledge of what were things like 10, 15, 20 years ago, how the eviction process was that much easier, how there was none of these tenant protections that are in place today. They only know a world of rent control because they were not investing in multifamily properties prior to rent control. So they come into the market, and based upon the strong financials, stable income increases over time, they're going to have depreciation for owning real estate. For all those reasons, they see it as a viable investment. And then why have existing investors dropped off? For the very same reasons. They have an experience when the judicial system was more even-handed, right? That, hey, a tenant can't just hang out in your unit forever. They can't play the game of extending and going to jury trial and all these things, right? Many of you know what I'm talking about. I'm not saying that it was easy. It just wasn't. Evictions weren't, what they are today. Insurance costs, right? Insurance was a fraction of what it is today. Tenant protections. Of course, tenants have always had rights, but not to the extent and the overreach of government that we have today. So one of the common statements that I hear from existing investors, individuals that have been investing, not just 10 years, but we're talking about folks that have been investing 20, 30 years. Kris, this game is just not as fun as it used to be. Multifamily investing has changed so much that maybe I'm going to keep what I own because it's seeing me through my retirement and what have you. I'm not interested in buying industrial or retail or commercial office. If I have to own, I still will own multifamily property, but I'm surely not adding more units because they perceive it as a negative, just taking on more risk for little reward. Now, I'm not saying I agree with that philosophy, but you can see from their vantage point why that would be, because they knew a world that was much different in multifamily investing. So the bottom line is, starting probably in 2020, we saw this shift of it being the vast majority of buyers today of multifamily properties is shifting to new buyers and less of the individuals that already own in the area. So 2024 brought with it new challenges, increased costs, but I would still argue multifamily properties are a great investment, and we're going to dive into, well, specifically what happened with property values and is it finally a buyer's market? Now, my team services specific what we call corridors, and that's where the information I'm going to speak to today, the data that we'll be covering. Those corridors are the East Los Angeles corridor, which consists of Boyle Heights, East LA, and El Sereno. The 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, and Southgate. The West San Gabriel Valley, Rosemead, San Gabriel, Temple City. East San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia. South El Monte, West Covina. 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier. Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. And Inland Empire East, Bloomington, Colton, Fontana, and Rialto. These are the geographic areas that we're going to speak to today. And why do we chunk it this way? Because typically when you put these cities together in this way, the rental rates are about the same, values, tenant base, and so forth. And that's why we've chunked it down this way. Let's start with the East Los Angeles corridor. Total sales, how many properties sold? Well, in 2023, 18 properties sold. In 2024, 17 properties. So in that sense, sales volume about the same. What's telling though is when you look at total dollars that sold. So 17 sales occurred in 2024. If you added up the total value of those properties that sold, almost $23 million. In 2023, that was actually a little more than 26 million, right? So although we're only one sale less, the values have slipped a little bit here. How else do I know that? Well, let's take a look at price per unit. In 2023, the price per unit was $196,000. In 2024, the average price per unit to sell of those 17 properties was $190,000. What about cap rate? Now, cap rate being, if you were to purchase a property all cash, what would be your rate of return? That's the easiest way to think about this. We have a video on our channel that explains how to calculate cap rate. But cap rate, okay, 2023, 4.59% is where we ended 2023. In 2024, that climbed to 5.43%. So right there, that tells you that values did decline in East Los Angeles. And what's also very telling is in East Los Angeles, it's governed by unincorporated LA County, right? They're limited to increasing their rental rates, at least last year, by 4%. So the fact that they only were able to raise their rents modestly and yet the cap rate increased was not a function of rents. It was a function that prices went down. Price per square foot, which I think is less telling, but in 2023, $328 per foot, average price per square foot that sold. And in 2024, $301 a foot. Total buildings that we're tracking in this corridor, 690 buildings that are between 5 to 50 units. Okay, rental rates. You could take a look at the chart, find your city, the bedroom, bathroom count, and that is the average rent. Now, these rental rates come from Rentometer and Zillow and CoStar. We take a look at the average rental rates, put that data together. So this is our current rental rates based upon our last rental survey that we do in-house. And so there's your rental rates for the East Los Angeles corridor. Shifting now to the 710-91 corridor. In 2023 and 2024, interestingly enough, we had 34 sales. Very interesting. Sales volume actually increased from $58 million in 2023 to $66 million in 2024. The price per unit did slip though. The average price per unit that sold in 2023 was $223,000 per unit. In 2024, $208,000 per unit. Cap rate increased from 4.81% in 2023 to 5.28% in 2024. Price per square foot went from $328 to $283, and the total number of buildings we're tracking here is 2,467 buildings that are again between 5 to 50 units. So again, we see that uptick in cap rate just like we saw in the East Los Angeles corridor, and will be a common thread as we walk through the various geographic locations. Now, here are your rental rates for the 710-91 corridor. Same idea. Take a look at the city you're interested in, your bedroom count. That'll give you the average of what you can expect should you have a vacancy currently. The West San Gabriel Valley. In 2003, we saw 7 sales. 2024, that jumped to 13, nearly 100% gain in total number of sales. So the area became more active. Sales volume increased from 32 million to 42 million. Obviously, that's reflective of the number of sales. You would think it would have jumped more, the overall sales volume, given there was almost 100% increase in the number of properties that sold. That also comes down to a mix of the properties that were involved. Price per unit also slipped in this corridor from $310,000 in 2023 to $291,000 in 2024. And cap rate, interestingly enough, went down from 4.95% to 4.2%. One of the few areas we're looking at where cap rates actually went down year over year. Price per square foot actually went up from $365 to $397, and total buildings involved here are 1,926. So the Western San Gabriel Valley, we're talking about Rosemead, San Gabriel, Temple City, has never been cheap, and the values are holding. Here's your rental rates from our current rental survey. Again, choose your city, bedroom count. There you go. Help assist you in where your rental rates should be. And the Eastern San Gabriel Valley. In 2023, we saw 27 sales. 2024, 32 sales, an uptick in the number of buildings that sold. Sales volume increased from 71 million to 88 million. Price per unit increased from 285,000 to 287,000. Our cap rate increased from 4.53% to 4.66%, but that's a modest gain. And price per square foot, $338, increased to $346. So you see in the Eastern San Gabriel Valley, price per unit didn't shift much. Cap rates haven't shifted much. So in other words, in general, what can you extrapolate from this is that the area still holds strong. These particular cities are performing well when it comes to sales prices. Now, here are your rental rates for the Eastern San Gabriel Valley. Again, just go down the list of cities and take a look at your bedroom count. That is going to be the average of what the asking rents are as of today. The 605 corridor. In 2023, we had saw 44 sales. And 2024, there was 48 buildings that sold. So a slight uptick nearly that 10% that we discussed earlier, 10% uptick in total properties that had sold. In terms of total sales volume in 2023, $166 million had sold. In 2024, $164 million had sold. So a slight drop off, but not much. The average price per unit in 2023 was $275,000 per unit. As of today, $244,000. So that is a pretty dramatic change. In terms of the average cap rate, 2023, 4.04%. And where are we today? We're at 5.21%. So that is definitely a change. So in the 605 corridor, fundamentals are strong, but you do see a change in values. Now, here's your rental rates for the 605 corridor. Choose your city of choice here, bedroom count, and those are your averages. The Inland Empire West. In 2023, we had saw 21 buildings sell. This last year, 2024, that slipped to 13 buildings. The total sales volume was $59, almost $60 million in 2023. In 2024, that slipped to about $34 million. Price per unit went from $256,000 per unit to $213,000 per unit. Cap rate increased from 4.77% in 2023 to 5.06% in 2024. And price per square foot dropped from $321 to $266. And total buildings here is 1,123. So obviously, values are off for the Inland Empire West. Here's your rental rates for the Inland Empire West. Got all your cities and your bedroom counts. The Inland Empire East in 2023 saw 7 sales. Last year, 14. So we saw a 100% increase in the total number of buildings that had sold. Sales volume jumped from 25 million the year prior to 32,600,000 in 2024. The average price per unit, though, did drop as well from 246 to 214 last year. The cap rate only increased slightly from 4.42% to 4.48%, and price per square foot stayed relatively about the same. And we are tracking about 287 buildings here, not a ton of inventory in the Empire East, but as investors were looking for affordability, this is about the best I can amount it to. They increased the number of properties that were sold, but there was still a shift in terms of the price per unit. And here are your rental rates. Find your city of choice, bedroom count. Those are the averages as of the beginning of 2025. So as we looked across the spectrum of these various corridors, something was very telling. Obviously, cap rates have gone up. Price per unit has come down. And why is that? Is it simply because, like I said, I mentioned at the onset of the video, the tenant protections, increased costs? That's a part of the puzzle. But the main thing having impact on property values, of course, is the increase in interest rates. And so let's walk through this because I don't want you to walk away thinking that every time interest rates increase, that means property values go down. Historically, that's not true. You take a look at, let's say, even 2006, just for the multifamily market, the tip top. Well, interest rates were at the highest they had been in that run-up, and property values were at the highest they had been in that run-up, right? So that's not necessarily true. But it is true for our current market, and what's plaguing the market is that we went from 3% to 6.5% in such a short period of time. And because of the limits on rental increases, that's the spread between cap rate and interest rate just it increased so fast and such a dramatic pace that's why we saw a stall out in sales when we're talking about 2023. If you go back to 2023, and that was a dismal year in terms of sales, especially the first half of 2023. And it was because investors hadn't yet adjusted, right? This new environment where interest rates were increasing. So then the lenders were tightening and things were changing, right, within that space. So let's go through some specifics, though. Let's go through the financials of exactly how this has played out. So what you're looking at here is a sample property going back to 2022. Now, in our sample property, this property is collecting $16,000 gross monthly income. In 2022, the sample property we're looking at, $3,125,000 based upon the interest rate at that time of 4%, average cap rate 4.25%. Now we move forward to 2023. Interest rates had moved from 4% to 5%. And on hearing that, one may say, well, there's only a 1% difference. How big of an impact can it have? Well, it has a significant impact on cash flow, because now what's happened is the spread, as we call it, between the interest rate and the cap rate has widened. Remember, our cap rate in 2022 was 4.25%, but the interest rate was 4%. That's only a spread of 0.25%. Well, now we jumped to 5% interest rate, right? So now that spread has increased. So as that spread increases, what happens? The cash flow on a property, the net cash flow, is significantly impacted. So a buyer says, hey, in general, I was making X amount of cash on cash return in 2022. Now interest rates have increased. Well, we're not in this business just for kicks, this to make a return, right? This is a business. So I want my return to increase. It has to increase from where it was. So in order to increase the rate of return, in order to shore up that difference between the interest rate and cap rate, you have to bring down the property's value. So that same property, which was once worth $3,125,000, is now worth $2,925,000, a $200,000 difference. That's about 6.5% difference in price. Let's carry that forward another year. So now we jump from 2023 to 2024. The interest rate had went from 5% to 6%. What happens? Cap rates increase. Same idea, because now we have to shore up that spread between the interest rate and cap rate. So now the cap rate, average cap rate, starts hovering around 5%. Well, in order to achieve a 5% cap rate on that same property, the price goes from originally $3,125,000 back in 2022 to now $2,750,000. Well, that's a difference in price of $375,000, or about 12%. So now let's move to 2025, present day. As of the recording of this video, the average interest rate for a commercial loan is 6.5%. So now that spread has widened between interest rate and cap rate. So we need to shore up that spread. So cap rates have moved to, say, 5.25%, between 5.25% to 5.5%. I'll give you an idea what that 0.25% difference will mean on the value. Let's say 5.25% cap rate. Well, our building, which was once worth $3,125,000, now is worth $2,650,000. It's a difference of $475,000 in price, or about a 15% difference. So if you were to pull the brokers that are most active selling multifamily properties here locally, like myself and my team, they would tell you, yeah, the change in price is probably somewhere, depending on the more desirable areas to the least desirable, it's at least 12 to 15%. Some places even greater than 15%. And maybe your building would be impacted by a greater decline in value than 15%, depending on what you've done with the rents over the last 3 years. I'll get to that in a second. So that's at 5.25%. Well, what if we just bumped the cap rate to 5.5%? Okay, from 5.25 to 5.5. Well, the building's value goes from $2,650,000 to $2,550,000. Another $100,000 hit for just a 0.25 point. That would be a difference of $575,000 total in value from where our sample property started back in 2022. So you can understand when I'm talking about interest rates, its impact on the market. We've walked through all the data earlier in the video in terms of what's taking place. There is a shift. And so now one might be saying or thinking to themselves, well, Kris, but on your sample property, had the landlord done a good job, they would have raised rents every year, right? So we have to account for that. Okay, so that our sample property, which had originally a $16,000 a month monthly net income, We're going to say that landlord raised the rents in 2023, 2024, each year by 8%. So now those rents would have increased from 16,000 to 18,662. Well, in order to balance out the cap rate and the interest rate, well, that building's value now is $2,950,000. So not as a dramatic change in price, right? The price has only changed by about $175,000, or say between 5 to 6%. So it does matter. The increasing your rents annually by the maximum, CPI plus the 5% base, the change in CPI plus the 5% base. Unless you're restrained because your city has a local ordinance, then obviously over time, your building is going to fall behind in value every year, because while the rest of us are raising our rents 5% plus CPI, we're able to tackle the change in interest rate better, or whatever the case may be, versus if you're only raising your rents, say at 4%, 3%, some of the crazy cities where it's 60% of CPI. Think about this. For those of you that own in an area where there was a rent freeze, let's say maybe in 2022, 2023, well, you could not increase your rental rate. So you would have seen, when I've gone through these examples, you would see the greatest impact on your property's value. It boils down to cash flow. And I would argue, and I know many would agree, that more than ever, because the upside on a purchase, it takes that much longer to achieve it because the limitation on rents. In general, investors are saying, I need to make a greater return day one when I close escrow, or what's the point? So that's the change here that we see in values, or the potential impact, right? Because interest rates have gone from 4% to 6.5% where we are today. Here's the point, and I agree that for those of you that have done a good job raising your rents to the maximum, right? For those of you that are not governed by a specific ordinance, then you're under 5% plus the change in CPI. So you've done a good job raising your rents over the last few years. Well, guess what? Your value then was not impacted as greatly. For those of you who didn't do such a good job, or for those landlords that say have a bleeding heart for tenants and, oh my gosh, I can't raise the rents more than 5% a year, and so you've limited yourself, or you're not even using percentages. You're saying, well, we always do it $25 per unit, $50 per unit. Again, I'm not judging anyone's management style. All I'm saying is, when you and I sit down and you say, Kris, please put together an evaluation for my property, we're thinking about selling, or we're just curious, what is our estate worth? And you're an individual, let's say investor A hasn't done a good job raising rents. Investor B has done a great job raising rents, always keeping track of the change in CPI and raising it to the maximum. Same building is going to have two different outcomes by what you've done with the income, of course. And again, those buildings that are the farthest below market rate have had the biggest impact to value because of where we sit with the interest rates. Now, will the interest rates go down? Will they go up this year? I don't know. I'm not an economist. I've read arguments on both sides. Obviously, if interest rates come down, I'll make the argument values will go up. Definitely. If we had some relief in the world of interest rates, if we could go from 6.5 to below 6, that would definitely stimulate the market. But I've read arguments that, well, actually the Fed is not going to lower the rates at all this year. Actually, they might have to increase the rate because they don't have a good handle on inflation. Again, I'm not an economist. I'm not here to make an argument one way or the other. My point is, where are we today? I would argue today it's a buyer's market. For those individuals that did not like the prices of 2021 and 2022 because you said the cap rate was too low, well, look at where we're sitting at now. Values have come down 10 to 15%. Cap rates have increased to, say, from 4% to maybe, say, 5.5% on average. And if you're looking at a property where, let's say, their next rental increases are scheduled right around the corner, something like this, obviously that's only going to bolster your rate of return. The bottom line is that I would make an argument it is a buyer's market. If we're simply saying, well, when values come down, it's a buyer's market. Okay. But can it be a seller's market? Well, it depends on what's your next move. If you're looking to sell and do a 1031 exchange, then it's all relative. Whether values are up, down, sideways. Remember, you're selling and buying in the same market. So yes, values have slipped. Yes, your building is worth less than it was 2 years ago. That's fact. Anyone telling you different is lying to you straight to your face. But if you're selling to do a 1031 exchange, then the building that you're going to buy has adjusted by that same amount or maybe even more, depending on what that investor has done with their rental rates and what have you. So your dollar goes further today. And again, I understand that you would be buying in a market where the interest rate is higher, but that's how we got the lower prices. That's how we got the increased cap rates. Prices were not going to go down and cap rates go up had interest rates stayed at their historic lows, right? The interest rates going up have created the stimulus for a great buying opportunity. And you'd be surprised. Again, in all these geographic markets that we work, we track all the sales. And I gave you averages here, but there's properties that are selling well below the average. And when I take a look at the asking price and the final sales price, sometimes the buyer, the investor, got a deep discount. Why would that happen? There's any number of reasons. We can't speculate here. Maybe the seller had a loan that was a ticking time bomb. It just readjusted to the new interest rate. They took a massive hit to cash flow. They said, that's it, we're selling. Maybe the increased cost, tenant protections, they don't like what they're seeing there. They're selling. They're going to go buy a triple net. They're just going to exit the market altogether. Maybe they're going to sell, purchase a DST, hands-off management, any number of reasons. And they see that motivation greater than hanging on for the sake of hanging on. So I guess I'll round up here by saying, what's your game plan for 2025? If you watched my previous video, I asked a very simple question. Based upon your financial goals, how much and by when? How much cash flow do you need and by what date? Have you tracked it out? Have you mapped it out? How many units would that mean, right? If we're talking about growth. And for those of you that maybe are looking for alternative investments, looking for exit strategies, that's pillar 3. Well, have you explored how do you sell and mitigate taxes? If you sell your property, what are you going to do to replace your monthly income? If you rely on that monthly income as your mainstay for your standard of living, if you sell, what are you going to do to replace that income? That is all that we do here at the Apartment Dealer, is we walk investors through what are their options, whether that be 1031 exchanges or looking for alternative investments, say like a DST, triple net, that sort of thing, even sell with seller financing. The bottom line is, I think I like the building because it's pretty and everything I do is predicated on my pretty building. But what are my financial goals? What would I like, what can I do today that my future self will thank me for? We start there, then the moves you make in real estate are predicated on that. I hope you found today's video helpful. I know this one went a little bit long, but I wanted to make sure you had all the right financials and you understood what's shaping the market as we begin the new year. I believe there's opportunity, and I believe even, again, amidst the challenges, there's going to be investors this year that are going to make a boatload of money because they choose to see the glass half full as opposed to half empty. If you have not already, subscribe to our YouTube channel, give this video a like, share this content with other investors that you know. I'm trying to get this information into the hands of investors so that investors are equipped with what's truth versus fiction, as opposed to what's being peddled out there by the talking heads, social media and what have you. But again, what's happening brass tacks in the areas that you own. That's my job here, at least the way that I see it. And until next time, this is Kris German wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.